Let's talk about double calendar spreads. A double calendar spread is an options trading strategy that takes advantage of the one certainty associated with all options contracts. They all expire at some point. If you already know what a calendar spread is, then you'll understand that the double calendar is simply an extension of this principle. It relies on the underlying security to remain within a price trading range up until the expiration date of the sold options. This is how you profit. So let's look at some of the advantages of the double calendar spread. Unlike a calendar spread, the double calendar spread extends or widens the range within which a profit can be realized. Not only so, but whereas a simple calendar spread uses only call or put options, the double calendar uses both and does so at the upper and lower ends of the trading range that you choose. Looking at it another way, you could say that the double calendar spread is like a short strangle strategy, except that the sold options have a short time to expiration. But to these, you add the same number of bought options and they have the same strike prices as the short options, only a later month expiration date. Since the later month long positions will cost more than the earlier month short positions, the spread will incur a net debit to your account. This debit will also be the maximum risk for this strategy. So let's have a look at a double calendar spread example. Let's say we are entering our position in May of any given year. We sell an equal number of June call and put options at strike prices, say $20 apart. So let's assume $50 puts and $70 calls. There's our short strangle done. To this setup, we now add the purchase, that is going long, of the same number of calls and puts, but with July expiration dates and the same strike prices. So in the case of our example here, we would buy July 50 puts and also July 70 calls. Most reputable brokers will allow you to enter all four positions as one trade rather than legging into them. But if you must leg into the trade, do one calendar spread first and then the next one. Looking at the risk graph here, you'll see that it looks like a tent. If the earlier month short options expire within the prices displayed in the tent, you make a profit. Continuing our example, should the price action of the underlying security subsequently explode beyond the $50 or $70 levels, one of your June expiration short sold options will increase in value, while the other will be way out of the money and therefore decline. At this point, you could choose to buy back your losing sold option for next to nothing and take a profit on that, and continue holding the losing July long position, allowing for the possibility of a reversal. Your other sold option, the one whose strike price has been breached, would ordinarily expose you to unlimited risk, but this will be protected by your longer dated bought option since they have the same strike price. The same principle can be applied to convert strangles into a double calendar spread. If the anticipated price explosion needed for strangles to profit doesn't happen, you just sell options with nearer dated expiration dates and the same strike prices to create your double calendar. So let's now consider the criteria for entering a double calendar spread. Before you consider placing a double calendar spread, there are a couple of things you need to see in both the underlying and the options themselves. Firstly, you should believe that the underlying will remain within a trading range for the duration of your short options lifespan. So, taking our previous example, that would mean until June expiration date. But here's the real important one. You should also look at the option's implied volatility for both the near month and the later month options. The best trades are made when you see a volatility skew. These occur when the near month options have a higher implied volatility than the later month options. Since you want to sell the near-month options, you would like to receive as much premium as possible, and this is why you look for these skews. If the longer dated options have a higher implied volatility than the shorter dated ones, stay out of the trade. Also, if the volatility skew is too good, it could be telling you that an upcoming company earnings report is approaching. Since these can produce unpredictable results for stock prices, you should first check that an earnings report is not on the horizon before entering a double calendar spread trade. This is one reason why exchange-traded fund options might be more preferable than company stock options. If the volatility skew is a reasonable one and shows at least a 2% difference in favour of the short-dated options, you have a good candidate for entry. And finally, your short positions should be no more than 30 days until expiration, because during the final 30 days, out-of-the-money options decline in value more rapidly. Your long positions can be 1 or 2 months later. Analysing the double calendar spread. Before executing your double calendar spread, the final thing you need to look at is a risk profile graph. Ideally, it should look like a tent with 2 peaks and a slight dip in the middle. The risk graph will show a range of stock prices at which the position will make a profit. Ideally, the current market price of the underlying at time of entry should be in the centre of the risk graph. This will allow you enough movement to the upside or downside before your break-even points are breached and any adjustments may be necessary. The beauty of this position is that because you are on the selling end of options contracts, you have theta, or time decay, working in your favour. Maximum profits are achieved when your near-month options both expire worthless because they are out of the money, while your long-dated options still have enough time value to close the whole position for a profit. Finally, you should never simply put this type of trade on and then just hope that the underlying will remain within the desired range until your short options expire. Here's the vital ingredient for success. The secret to making consistent profits with double calendar spreads is to learn the art of adjustments. These adjustments are explained in depth in the very popular Options Trading Pro System video series. Knowing how and when to do this is the key to enjoying a consistent monthly income stream that will never fail.